Good morning, everyone. Great to see you again. My name is Jack Moriarty with Rutgers and the Lafayette Square Institute, and it's my pleasure to introduce our next panel discussion, New Frontiers in Employee Ownership Finance. Access to capital is a central theme that we heard throughout the day on Capitol Hill yesterday. We heard it from Senator Van Hollen and the bipartisan legislation that he's leading. Folks, if we could move our way. Can't hear in the back? Excellent. Start over? Okay. Well, good morning, everyone. Jack Moriarty, Rutgers, Lafayette Square Institute. It's my pleasure to introduce our next panel, New Frontiers in Employee Ownership Finance. As we heard yesterday on the Hill, access to capital is a central theme in the employee ownership field. We heard it from Senator Van Hollen and the bipartisan work he's leading in this area. We heard it from Jim Bonham of the ESOP Association that access to capital is a key element of a broader ESOP advocacy agenda. And today we have the privilege of hearing it directly from leading investors and practitioners across the employee ownership field that are either deploying, raising, or allocating capital to grow employee ownership. A few years ago, an analysis by American Working Capital showed that employee ownership is currently only 0.3% of all U.S. M&A activity. As Chris Mackin likes to say, we are a spot on the sun, a drop within a drop in the bucket. This status quo is both an investment decision and a policy choice, and we can choose differently to bring the full weight of capital markets to bear to grow employee ownership and enable workers and families to build wealth and economic security. The 5 members of our next panel are all pioneers in this field, and they've chosen differently to create innovative ways to finance the growth of employee ownership, and with it, a more dynamic, resilient, and just American capitalism. I'd like to introduce very briefly our moderator, Melissa Hoover, who's Senior Fellow at the Rutgers Institute in Special Projects at the Democracy at Work Institute. We also have Amy Brakeman with us, co-founder of the Unlock Ownership Fund, Zoe Schlag, Managing Partner and founder of Common Trust, Phil Reeves, co-founding partner of Apis and Heritage Capital Partners, and Jim Sorenson, the founder of Sorenson Impact Group. And with that, I will hand it over to my colleague, Melissa.
Thanks, Jack. So I'm thrilled to be here today to talk with these giants of innovation and capital for employee ownership. To get started, why don't we just do an introduction? So introduce yourselves, your organization, and kind of where you sit in the world of finance. And tell us a little bit about what brought you to employee ownership. Jim, do you want to start?
Yeah, great to be here. As was mentioned, my name's Jim Sorenson. I'm founder of the Sorenson Impact Group, which is really a multidisciplinary collaborative that is really focused on really building the ecosystem for impact investing. And my journey here really is in recognizing the tremendous need and impacts in society around ownership. And of course, employee ownership is key to that. As I've looked at my life and the success that I've been able to have in building wealth, in large part has come through employee ownership. So very interested in supporting employee ownership and really ownership and passive ownership of other dimensions to help those that that don't have the opportunity to be able to build wealth and really impact future generations. That is going to be essential for us to thrive in this country.
Sure. So Philip Reeves with Apis and Heritage Capital Partners. We are an investment firm that's focused on using employee ownership to close the racial wealth gap. And so we find great small businesses all around the country that have workers of color and convert them from being founder-owned or family-owned to being now employee-owned. And when we say employee ownership, we use the ESOP structure. And so far, we've done 4 transactions, have around 400 workers, owners in those companies, and are really excited for today's conversation. So thanks for having us.
And what was it that brought you to employee ownership?
I mean, my background, I have people in my family that own small businesses. I spent a lot of time in the D.C. Area and got to see the power of ownership in the Black community. And I think for me, it was watching those owners build these great businesses, they were able to put their lives, their children, their generations onto this great path. And it was really understanding that those entrepreneurs that got all the success had beat a ton of odds. And most people aren't going to get that opportunity. But employee ownership was a way to give people that chance without them having to mortgage their home, start a business, and just, surmount these massive things. And so we, the firm, our whole idea is if we can spread opportunity and spread wealth, particularly in communities of color, we can really take this racial wealth gap that is actually a chasm and start to narrow it just a little bit.
Hi, everyone. I'm Zoe Schlag. I'm a co-founder and managing partner at Common Trust. It's really nice to be here. Phil and I were actually joking at the beginning of this. Usually we are the only ones in the room who are working on employee ownership or may even know about it. And I feel like this room, everyone is working on it. So it's nice to be among familiar faces. My firm, Common Trust, supports businesses to exit through employee ownership trusts. We do that through two ways. One, we have an advisory side of our business, which is supporting businesses to design a customized employee ownership trust. The other side of things is we have a fund that provides the capital for those buyouts. And what brought me to this space, candidly, was disillusionment and an existential dilemma. I'm now working on the buyout side of things, but 5-6 years ago, I was an early stage investor. We were investing in mission-driven companies that were building tech products to solve social and environmental problems. And, as I was investing in these companies, I had this question in the back of my mind, which is like, okay, so let's say we succeed in scaling these companies and products to impact people's lives, particularly with those products that were designed around addressing questions of wealth inequality. When those companies go on to exit, given who sits on the cap table, net, are we making wealth inequality better or worse? So this is something that really got me to start to think about ownership as a theory of change. And that's really what led me to getting to work on these employee ownership buyouts.
Okay, I'll just echo all what they said, except my name is different. My name is Amy Brakeman. I was able to have access to the ladders of success in our culture: education, employment, making enough money that I could start being giving away philanthropy too. And at some point I looked around and said, you have these awakening moments that, the system is really driven so that people like me will succeed. And it worked for me. And then I noticed how many people, the bulk of Americans, are left behind and don't get the opportunities I get. So what can I do to shift that? And so I started having the good fortune of probably things that Jim seeded, being an impact investor, started seeing still that even in impact investing, a lot of the money is still going to prioritize market rate returns for investors like me, even though we are also trying to drive sustainability and better distribution of the economic system. So my wake-up call in employee ownership was that when I met Phil and Zoe and a few others, unfortunately there aren't that many to invest in, but CDFIs have been doing this work for a long time, I said, oh my gosh, here it is, because I was already aligned as a racial wealth gap investor. And so I have moved very rapidly. A lot of people who know me say I move faster than most other investors. I'm in 17 equitable asset ownership investments, and now I'm using my voice as well as my money to try to see if we can build more of an ecosystem of investors moving rapidly into these models that, thanks to the researchers out there, you have proven, and to the practitioners who have led these businesses, you have proven this is better for workers, better for the companies, and better for local communities. So let's do it.
All right, let's do it. So we have a really cool panel, and I would invite us to have a discussion as much as sort of question and answer presentations. So feel free to respond to each other, tack on as we go. But I'll start us off with some questions. So Phil, let's start with you. Can we talk a little bit, can you speak to investors' perceptions of employee ownership and maybe some of the myths around return that pose obstacles and what you're seeing get traction with investors?
Sure. So we raised our first fund in 2021, and I think that, the stage is great. Employee ownership as an asset class is just super new. particularly for a lot of allocators. And you have new teams doing new models that aren't taught in business school, aren't taught in law school. And that's just hard for a lot of investors to get their arms around. Never mind that, LPs have boxes like credit and equity, and employee ownership does not fit super well into those boxes. And so for a lot of investors, employee ownership is an easy no. Like, it doesn't fit in my boxes, and everyone's super new, and no one has track record. I'll just pass. What we found was when we spent time with investors and they really put in the cycles, I think what LPs appreciated was you can do both. You can have great returns and have these sustainable outcomes for communities of color, but it just takes getting over those hurdles. And so our LP base has been phenomenal in that they actually took the time to understand the model, to appreciate how it works. And I mean, a huge credit to the Sorenson team. I mean, Sorenson was our first institutional check, and that was huge for us. And so now you're seeing other teams get funded, and hopefully what this does is it lets the field realize, when I say the field, I mean the investor community realize that these models do work. They generate great returns, and I think the LPs that have taken the lead are doing a phenomenal part of getting us to the next level. In terms of myths, I think the greatest myth there's a lot out there. I think the one that still persists today is all around pipeline and opportunity and how many deals are there. I think there's a perception that employee ownership has to be a small company, like it's the co-op grocery store or the coffee shop or the bookshop. And I think yesterday's panel was a great showcase of just how large some of these things are, even some entrepreneurs today. And that story has to get told. The other one is, and actually happened yesterday quietly, is that employee ownership is a buyer of last resort. And you hear that sometimes, but the challenge is that what that means to investors is it must not be that great of a company. But that couldn't be further from the truth. And I think it takes models like what we're doing to break that paradigm. I mean, MOA was a great example. For those that don't know, our latest transaction, Sky Blue Builders, we were not the only buyer there. We, in fact, were not the first buyer there. But we were able to win that transaction in a competitive process, and we think that means we can get great assets and deliver great returns for our investors and deliver great impact for those employees.
Thank you. Oh, wow, an applause line. So, Amy and Jim, let me turn to you to build on Phil's remarks. Why do you think so much capital is staying on the sidelines when it comes to employee ownership? And for the capital that's moving, why is it moving? Do you want to go first?
Well, we're going to try to experiment with that at Unlock Ownership because of what Phil described. Not many investors are in this room right now. Like, how many of you are asset allocators? I mean, okay, great. Yeah, I know both of you. Great, you're involved. You're on the investment committee. It's excellent. But it's just it is a new space that it's not new space. Sorry, it's a space that people haven't invested in. And so there's a lot of learning to do, and part of what we're trying to do is make it easier for others to invest in this. We are now a fund, Unlock Ownership Fund, with 4 co-founders who are doing the initial investments through decisions led by an experienced investment committee. And we think that might help remove some of the barriers for people getting involved. It is catalytic capital, so it will be our first funding is from DAF funds, donor advised funds, and foundation funding is also welcome, PRI funds, so that we can just make it easier for others who can't build the capacity. I have 3 investment advisors. Only 2 of the 3, one's actually very, very good, and I'm surprised they're not here, very involved. But the others just are not in this space, and they don't have enough clients that are interested in it to make it work for their business model. So I'll stop there.
Yeah, I would echo, I think, both what Amy and Phil have said. It's new. I think there's also kind of a notion that it's concessionary, that you're not going to make market rate returns. I think that's quite often the case whenever you're dealing with something that has, I think, a real social good aspect to it. And part of the things that the thing that we're trying to do in building the broader ecosystem with our foundation is essentially to show that there's a spectrum and that you can make market rate returns with impact investments. And in fact, our decision around APIS and Heritage was to put it in our MRI portfolio as opposed to our PRI portfolio. And it very well could have been, but we really felt that it sent a strong signal, and we felt that it met what our requirements were to be able to underwrite. And I think we're off to a very good start. So I think over time, and as there's more experience, more success, this will change, and that is what we want to see in this space. And I think there's also great opportunity for ways to blend in market rate investors by utilizing tools like grants and program-related investments to help in de-risking these investments. So there's, I think, some financial innovation that can also come to play.
Yeah, that's an important part that we didn't talk about. I mean, part of these are emerging funds, right? And we all know there are real challenges and barriers to emerging funds, especially if you're anyway. So yeah, that is the role that catalytic capital can play, coming in to de-risking the launch, so that's the way we see our role in the ecosystem at Unlock Ownership Fund, that we can de-risk, making it easier for Phil and Zoe and others to demonstrate that they have a model that then can attract the more mainstream investors after they've gotten the ability to demonstrate several deals or transactions.
So I want to build on a couple things that Phil said. The first piece is the buyer of last resort, employee ownership. This one is actually really interesting to me because I wish I knew the specific percentage here, but if I were to look at the businesses in our pipeline and the deals that we're working on, a large majority of them have turned down other offers from other buyers. They have turned down private equity. They are trying to get bought out of private equity. They are trying to pull out of an existing holdco, and it's because the capital structure doesn't support the way that they want to run their business. So I think that's something that's actually really interesting, because most of when we talk about employee ownership, it is the silver tsunami and these baby boomers who are ready to retire, but there's actually a huge amount of opportunity with businesses that are looking to get out of capital structures that don't necessarily support their long-term goals. The second piece that I wanted to touch on relates to LPs getting into the space, which is I don't think that LPs really understand easy comparables when they're looking at an employee ownership fund. That's particularly true with equity, also with debt. I think one of the things that's really important is with an employee ownership deal, as you said, Jim, a lot of investors think that view it as concessionary. The point I would make is that you're not necessarily trading away return with no commensurate adjustment in risk. I think employee ownership is actually a really strong way to manage risk in these businesses over the long term. And then, sorry, I'm going on a bit of a ramble here. The last point I wanted to make is just around how do we get more capital off the sidelines. And, I think we talk a lot about how do we build market education among selling owners. The same is true with banks. So when we're bringing senior debt into deals, it is not an easy button to bring them into deals. There's a huge amount of education that has to go on with these senior lenders to help them understand, how do I evaluate this? How do I present this to my credit committee? How do I get comfortable given that this looks a little bit different than most of the deals that come across my desk?
Just to follow up on the de-risking, so full disclosure, I work with A&H, so I'm pretty familiar with the model. Your capital isn't concessionary. It does, particularly from your philanthropic investors, it is accompanied by grant funding to invest in the building of ownership culture, and I think it's an important part of the model because we know that that's what drives value in employee-owned companies. So can you speak to that a little bit?
I think you hit it. I mean, I think one of the big takeaways from this conference, particularly yesterday, was around this idea of ownership culture. I think what I hope everyone took away was that it is a very intentional thing that takes real time, real effort, and real money to do. And so I think we were fortunate, Amy, to your point, because we have a blend of capital, we're able to use our more return-focused capital for actually doing the investments. And then we have grant dollars to support this training that goes on in the companies. But without that training, and we say all the time, like an ESOP without the training is just like a retirement account. Like it's cool, but it's not going to do anything. What we want is employees that will stay longer, that will go the extra mile, that understand their role in the P&L, and that just takes a significant amount of time, energy, and capital. And we're fortunate enough to have. And so that's why I was super interested in the last panel. Like workforce dollars is a way to offset that. We're following up on that. Like that's immediate.
Significant time and capital, and yet relatively a pretty small fraction of the total raise for a really outsized return in terms of it.
Yeah, I mean, in certain like scale of a deal, you're talking, a six-figure amount of capital over a few years is going to deliver. It's going to deliver meaningful, in our experience, meaningful outcomes from a P&L perspective, whether that's retention, EBITDA, whatever it is.
Great, yeah. So we're already sort of getting into it, but let's dive into your models a little bit more deeply. So Zoe, can you talk to us about EOTs, sort of break it down, employee ownership trust, and how you think about their value and niche in this space, and maybe give an example of a firm or two that you've helped convert?
Yeah, so employee ownership trusts are relatively new on the scene here in the United States as a mechanism for employee ownership. It is a trust that holds a company on behalf of the employees. So when you think about an employee ownership trust, the mechanism of economic gain for employees tends to be through profit sharing. So the other piece is that employee ownership trusts are a long-term ownership structure for a business. So when you sell into I can briefly explain the capital structure. When you sell into an employee ownership trust, typically you're bringing together some amount of senior debt from a bank. We have a mezzanine debt fund, and then seller financing that capitalizes a transaction to buy out the shares from the selling owner, to move those into the trust, and then lenders are paid back through company cash flow over the long term. What that means in practice is that the business exists in that trust for the long term. It's kind of a perpetual ownership structure. The piece that I think is really interesting about this legal structure here in the U.S. right now, and what we're seeing in a lot of our deals, is that employee ownership trusts allow you to encode specific company values or missions or purposes. And I'll give you guys a couple examples. We're working with a manufacturing business right now that has been on a net zero emissions pathway for the last couple of years. They actually have turned down several PE offers because they are nervous that if they sell to the private equity firm, that net zero emissions strategy that they've been working on might be erased. Another example is a business that has a workforce development program where they've partnered with a nonprofit to provide quality jobs to disabled adults. And that's something that's really important to this business, its culture, its founder. And so that's an area where you can code those types of things directly into the trust and protect those over the long term. And an example, I'll give you one example of a business we financed about a year and a half ago, Schlag Auto. They're based out of Provo, Utah. This is a group of 4 auto shops originally owned by 2 brothers, quite close to you. When they were ready to exit, Kevin, the CEO, he actually had known he'd wanted to exit through employee ownership for quite some time, since he and his brother started the business 20 years ago. So we financed the transaction with debt and seller financing. This was a year and a half ago, and the results in their first year and a half have been extremely impressive. This is a steadily growing business. In their first year since transacting, they've been able to double their profits. I'm not going to lean entirely into my confirmation bias. I think there are many things that went on beyond employee ownership, but I think that's an important piece of the picture. They've also been able to distribute record profit sharing to their employees and meaningfully have had their highest customer satisfaction ratings in 20 years of company history. So. I think it's a really
double profit.
Yeah. I think it's a really powerful example of the model and its potential.
Well, thank you. So, Phil, A&H has also been ramping up work. Can you catch us up to speed on your latest deals and what you're learning from those?
Sure. So we've announced we did 2 deals a couple of years ago, and then 2 more recent ones. The first was Blooming Nursery out of Oregon, and it was a few things. So one, it was our first rural deal. This is 2 hours outside of Portland, and we had never sort of been in that environment before, particularly in the ag space. But it's a plant nursery that specializes in, like, when you go to like Home Depot, they don't sell there. They sell to like the specialty garden center in like the cool neighborhoods. And so, but what makes it so special is that they've actually branded their plants. And so now, this is like the point around, it was a great business with a great brand. I mean, they've given plants to the Smithsonian, to the National Arboretum, because they're that high quality. And so Grace Dinsdale, the owner, has had this family farm for 41 years and was trying to figure out what to do. Private equity has not done well in this space, probably for obvious reasons. The idea of employee ownership, she didn't know it was possible, but when she heard it, she literally broke down in tears. Like that, it meant that much to her that her family farm would stay in her family business with her employees. And what animated us in it was obviously the investment thesis, but from an impact standpoint, about a third of their workers are women. And it was our first time having such a high number of women in our portfolio, so we're super excited about that. From a lessons learned standpoint, you know, when we do these announcements of like, your company's not employee owned, I think people have this myth that it's like, people jump up and down like, oh my God, I'm employee owned. That's not how it happens at all. Like it is, people are terrified. Like you just told them the woman that has run this business for 41 years is leaving, and these guys, we don't wear suits, but these guys in like these button downs come in. And so a lot of our work is around building trust. And this time, because we had a portfolio, we bought one of the senior leaders from one of our other companies to the business. And this workforce works entirely in Spanish. So we have live interpretation. All of our materials are in Spanish and English. Because we were able to bring someone that had been with A&H as a worker to speak in Spanish to a set of new workers, that's how you build trust. It's not me telling you that this is going to be great and you're going to have this great retirement account. It's Adrian saying, I've worked with these guys for a year and look at what's happened to our shop. And it just, I think for us, that was the biggest lesson. Is it's never going to be on us to tell a story. Workers are always the best advocates for these stories.
Fantastic. Thanks. So Amy, tell us more about the Unlock Ownership Fund, where the work's at, where it's headed, where you hope to be a year from now.
Thanks, and thanks to Rudy, who wrote up an article about us in Impact Alpha last week. Thank you so much. We came together as a collective of investors who are working toward reducing household wealth with a particular focus toward reducing the racial wealth gap. And our two specific levers, because of research, again, that show that these are really big levers in building asset ownership for low-income Black and Hispanic families. I'll use that word because those words because that's what the Federal Reserve uses. I know there's lots of different language to use. So we are investing in emerging funds that will be driving those two theses. So it's a little bit weird. I haven't yet found the conference that looks at home ownership and employee ownership, but we think both are very important levers, and there's some good investable options like Gary Community Ventures over there shepherding the Deerfield Fund for Black Wealth and other funds in the homeownership space. I think the value add is what I've already said. We're trying to leverage this ecosystem to help make it easier for other investors to participate and not sit on the sidelines. So we will see how that goes. We're just launching.
Exciting. So on the other end of the spectrum, Jim, you've been doing this for a while. Can you talk to us about your experiences and successes investing in this space, and in particular, what you think might be helpful to other investors?
Well, again, I think some of the principles that I talked about early on about catalytic capital, utilizing all the tools in the toolbox to leverage capital that's very much in the headlines these days, along with the ownership economy. I think clearly the successful use cases that are being developed by APIS and Heritage and others are going to be really important in that. And then I think enabling legislation that is, really in the works, and we've been a little bit behind that with Jack and others here. I think that wherever we can collaborate and bring in ideas, I think of Pete Stavros and the great work that he's done and what KKR has been able to do in terms of their funds. There's some great examples there, and if we can build a bigger tent, I think that it's going to help everybody.
Can we stick with policy for a second? And can you say a little bit more about the policies or lack thereof that you think need to be addressed to marshal more private sector resources toward ownership?
Well, I think there's a real great opportunity because my experience with policy as it relates to impact investing in this space has been really encouraging. I mean, you look today in Washington and it's so divided, so polarized, and so politicized that it's hard to have any kind of faith or encouragement about getting things done. Now, to counter that, in the limited experience that I've had as it relates to policy, when you can show both sides of the house that you can address a social problem utilizing free markets and capitalism in a good way, it tends to bring everybody on board. And I think that that's really the basics behind the legislation that we're crafting here. And I think that is the recipe for successful policy as it relates to bringing both sides together.
Right. Anybody else want to speak to policy before we move to sort of bigger visions?
It's critical. And thanks to Jack and others and many of you here who are working on that lever.
Great. Yeah. So before we move to audience Q&A, I'd like to ask each of you to share some final thoughts on something we haven't discussed yet, or something you think is important as we think about scaling finance and moving toward some of these market-based solutions. And I have some prompts, but feel free to riff. So Amy and Jim, let's start with you. I know both of you have a much wider framing around this issue, so let's end on that bigger picture vision. And I'll start with you, Jim.
You bet. Well, I think that employee ownership is really important, and I really support it, and 100% there. I would also say that there are other facets of ownership that shouldn't be overlooked. I'm very fortunate in my life that I was able to participate in a company-sponsored 401k. And I think that so many people are left out, particularly gig workers, in being able to participate in owning stocks and appreciating assets through a 401k. I think I'm encouraged with legislation. The Retirement Savings for American Act, which really utilizes the federal savings and thrift plan to enable gig workers to, again, have stock ownership. I think employee ownership through ESOPs is critical. I think that home ownership is really at a critical stage where so many are left out of the American dream. And we see really appreciation being used to the detriment of homeowners, with private equity firms basically buying up homes and then turning them into rentals. And we need to turn that around. And I've been really investing and looking at models that would unlock home equity to the use of those that either want to get into a home or those that own a home. And Amy will have to talk to you about some of these interesting ideas. I think you have to go where people are. So I'm interested in new models of, tenant equity vehicles for those that live in apartments to be able to share in ownership appreciation, and also community models. So there's a lot that's developing and happening in this space, and it's all for the good. And I think where we can utilize our innovation and looking at ways to orient free enterprise and capitalism to benefit people, to include people, to build on-ramps for them. That's what I'm interested in as it relates to policy and this area.
Okay, I'll pick up on that last phrase, the on-ramps, because that's what I started my comments about, is that I realized I had on-ramps and others didn't, and I became more aware those are systemic. A lot of federal policies that blocked people of color in particular from gaining housing, workforce benefits, all sorts of things. So it is systemic. I mean, these problems are systemic. So all of you working at the policy level, that is probably the biggest lever. Finance is a huge lever, right? We know what drives our economy, so we have a role to play too. My wish list would be, I came out of just being an individual investor with my own little decision process. I would love to see us come together more as a collective, as on the finance investor side, understanding what different roles we can play. We work a lot with Smitha at World Education Services. Like, she's thinking a lot about this. What are the ways we can come together more? Catherine Toner's back there, also from Gary, working the policy and finance lens. But we can think, Ford Foundation mentioned, Margot's working really at supporting convenings like this. It's incredibly important. But if we really had a better understanding, so we mentioned the banks, like if we had a better understanding of who is in each ecosystem, whether it's in finance, whether it's employee ownership or home ownership or some other equitable broader asset redistribution model, then we could work better together instead of, we meet here and that's great. But if we had the old McKinsey and consultant had in me is like picturing some little chart that moves from left to right, like who's helping build the ecosystem, who's helping build the emerging funds, which banks do we need to have then in this thing, and then who are the, quote, institutional investors that are going to come in. And so I would love if coming out of this, we could somebody wants to start working on that. So we're not working in silos anymore. We won't get there.
Yeah, so I'm hearing themes about broad-based ownership across the board, and also see Amy at lunch if you want to work together. So Zoe, can you tell us a little bit about, EOTs, employee ownership trusts, are a relatively small part of the picture. What do you think we can learn from them that'll support growth more broadly?
Yeah, I think in that case, it's actually really interesting to look at what's happening in the UK. Like I mentioned, EOTs are relatively new here in the US, but in the UK, we've actually seen significant growth of EOTs. I think the recent stat I saw is they have grown to 1 in every 20 private sales over an 8-year period, which is insane, and we should all be asking ourselves, how can we replicate that pace of growth here in the United States? A big piece of that is going to be policy. The second thing that I think about is market education, and I think the thing that I have been thinking about recently relative to market education is what level of market education needs to be mimetic and what level needs to be technical. The banks need the technical information, and anyone who is in these deals really need a deep technical understanding of how to structure and capitalize these employee ownership buyouts. But there's also a huge amount of mimetic education that I think needs to happen, which is every single person in this country should know that if I go to sell my business, employee ownership is an option. And I'm sure you guys experience this all the time, but I'll talk to business owners who I'll tell them what we do, and they're like, I wish I'd met you 5 years ago. I already sold my business, and I didn't even know this was possible. So I think there's work to be done with the folks in this room, because we are all working on different models and different angles. How can we come together on the mimetic side to really ensure that everyone knows that employee ownership is an option?
And speaking of education, what does mimetic mean?
Mimetic. Yeah. So the way that I'm thinking about this is like the meme, employee ownership buyouts. So there's a private equity buyout, but it's like it encapsulates the entire concept and has carrying capacity across society. So people understand that as a concept and idea. They don't necessarily need to understand how the transaction is structured for an EOT, how the repurchase obligation works for an ESOP, but they do understand that an exit option is employee ownership and can pass that along to their mom, their dad, their aunt, their uncle, their friends.
Thank you.
Thank you. Good question.
I'm so glad I can be part of the generational shift towards memes of employee ownership. Fantastic. Okay, so Phil, the A&H, Apison Heritage, takes a particular approach with a really clear lens on racial equity. How is that shifting the conversation in the space, and what change do you hope it catalyzes?
Yeah, I mean, I think we're upfront about that. And I think that that's important to us. And because you'll hear these stories of employee ownership, but you don't hear them in communities of color. Like the 38 years of history, the manufacturing firm in Iowa, you just don't hear it. And so we're bringing that message there. And in doing that, it's really, I mean, on one side, there's a lot of pushback against that concept, but we can't solve inequality if we can't solve inequality for everybody. And so for us, it's also just a good investment thesis. Like the industries that over-index for communities of color, healthcare, landscaping, commercial cleaning, general contracting, these are not businesses that AI is going to take. In fact, we believe that the labor shortage is going to be exacerbated. So today, if you wanted for every plumber that retires, that comes into the industry, 3 retire. Pretty soon, for every plumber that retires, 10 are going to retire. And so just put your investor hat on. If it's that hard to get a plumber, then the only plumbers are only going to work at places where they can own the firm. We believe that. We're trying to be the firm where all them plumbers come, honestly, so we can raise the prices and get margin. But it's going to be great for us, the workers, our LPs. But broadly, that's what we think the service economy can and should look like. And so it's paramount for us, and hopefully something that I think. And the last piece is just around the communication. To Zoe's point, the communication around employee ownership. When you talk like an employee to employee, or like the work that's done to create ownership culture, it is often not done in low and moderate income communities, or like blue collar workers, or workers that speak a second language. And so the last panel having 3 languages that have, materials in, that's huge. I mean, we're dealing with this every day. Like, how do we explain vesting to someone who's never heard that concept before? We're open to ideas. Right now, I think a Kit Kat is a great example, because you have a Kit Kat, and you get 1 quarter every day or every year. The firm doesn't like it. I like it. So, but we need more and more things like that so that we can get people to get it. And that, I mean, for us, that's the biggest thing, is getting this to low-income industries, getting this to low-income workers in their language and honoring their culture is huge for us.
Great. Yeah. Thank you. I told you it was the coolest panel. So I think we're ready for questions from the audience now. Okay, wow, a lot of hands. I think what I might do is start with do we want to start with the folks online?
Yeah, let's start
Okay.
online, since they had some disadvantages yesterday. I'll go with a couple questions, and then I know Jason has a number of questions in the room. But first question from Matt Kropp from the Vermont Center of Employee Ownership. Could you speak to the limiting role of seller financing and how new approaches are changing that calculus? One question. And then one more online from Joe Racinos that he submitted yesterday that I wanted to circle back around to. Louis Kelso advocated using the rediscount window of the Federal Reserve to offer low capital credit through private banks to finance new capital growth of ESOP companies. What do people think of that? And I would say, whoever answers that question, please explain what the rediscount window is as well.
Let's start with the first one, the seller financing question. Folks have creative ways of
Can you repeat the
Matt, can you repeat that question for us on seller finance?
Just talking about the challenges and limitations of seller financing and how people are thinking about new approaches to kind of address that situation in calculus.
So I'm probably an outlier in my perspective on seller financing in this room, which is I see it less as a barrier and more of an opportunity. Specifically, we're seeing a huge amount of seller financing in the deals that we do. In fact, the last 2 deals that we did at Common Trust were 100% seller financed, which is like blows people's minds in finance because structurally that can't happen if you are in finance. But I think the really interesting thing there is that there is appetite from sellers to participate at this level. And I think the really interesting thing to me about seller financing is it comes with less constraints than capital vehicles. It doesn't have a fund life. They can be more flexible to the business and their needs. It's easier to do curative processes with the former owner of the business than otherwise. So I'm actually really interested in how we look at seller financing, not as a barrier, but as an opportunity to provide more aligned financing for these deals.
Do you want to say anything about how you approach
I mean,
the seller?
I'm going to take Zoe's back to our next deals. So we to date have used a lower amount of seller financing. And so in the traditional ESOP deal, it was a senior lender and these really large seller's notes. And we always viewed that as a barrier for a lot of sellers, particularly sellers of color. Because if you're trying to retire, you're trying to move on from your business, and someone says, okay, great, but you have to put this 10-year note forward, there's just not many people who can do that. Like, their life isn't set up. Like, they don't have a separate 401k. They've been a business owner their whole life. They put their money back in the business. And so we think, however, that seller was good paper. Like, the traditional seller's notes out there by all the ESOPs, they have really, like, the default rate on the ESOP, NCO did a study, it was 0.2%. No. Yeah, 0.2. So not 0.2%. And so we think there's a lot of room around trying to reduce those sellers' notes. And the other thing we do to again, bring more people to the space is setting up an ESOP is just super expensive and complicated and needs a lot of inputs. And one thing that we do for sellers is we actually pay for the cost of setting up the ESOP. And so again, we're trying to say to a seller, selling to your employees can be as simple and frictionless as selling to private equity or a competitor.
Great. And then there was a second question that I might need a little help remembering, a bit complicated.
Yeah, I'm not going to be able to. I'm going to have to read that one. Lewis Kelso advocated using the rediscount window of the Federal Reserve to offer low capital credit through private banks to finance new capital growth of ESOP companies. What do people think of that idea?
We can also pause.
Phone a friend.
What's that?
Phone a friend.
Phone a friend.
I'm like, there's a lot of the.
We'll leave that one for the audience to chew over. Why don't we take a batch of questions? We've got Jason, Daniel, and and Leslie, and then I'll do a second batch. But go ahead, Jason.
Thank you all. This has been it's lived up to the hype, this panel. Thank you. My question is about what you have considered, if at all, giving the employees of the companies you've invested in or acquired, giving them exposure at the fund level to further kind of enrich and create circularity in the economics of the ecosystem that you're building.
Okay, and before we answer that, I'm just going to bunch them up. So if you want to go ahead and ask yours, yeah.
Sure. So you talked about the spectrum from grants to catalytic investments to market return investments, but nobody said any numbers. So from an LP perspective, am I investing in an evergreen fund? Is there a time horizon? Is it fixed income, equity? What kind of return? And then from the company perspective, what am I paying? Because I once, as CEO and president of the ESOP, talked with a very well-known fund, and they came back with really expensive mezz debt, which, quite frankly, there's no way I could pay. So I'd just love to get some numbers from both the LP side and from the company side.
I can just quickly say, like, when I invest in some low income, from one end, it's grants. And I've made several grants in the space. No return from a financial perspective, hopefully big return from an impact perspective. You always have to be talking about both returns. I've done some notes in CDFIs that could be like 3%, 3-year notes, investing in cooperatives, by and large. And then these guys can speak more to their return profile. I'll hand it to them. But those are market rate funds.
I'll just give you, and of course, this really depends on the asset class where you're investing. But an example, in our impact real estate, we really have two classes of investors. CRA banks are willing to take a haircut, so to speak, a 7 to 8% return. And they help leverage in market rate investors that are looking at 10 to 12. And of course, for CRA banks, it's critical that they meet their requirements. So, this all structured. When all is said and done, I would say on average, we're looking at about a 25 to 30% concessionary versus market rate. There are other examples out there, again, different types of funds, debt or equity, where foundations have come in with first loss capital or loan guarantees to help de-risk the transaction, to bring in really even a second concessionary, which is a little less concession, and then ultimately leverage in market rate investors. There's a lot that can be done that in this space if you're really creative.
Yeah, senior note, subordinated note, get different rates and take different.
And the cost of capital to the company, what on average are they to pay back these investments?
It really depends on the deal, to be honest. I think as an operator, the thing that I would have in mind if you are looking at structuring an employee ownership deal is looking at the return to the investor and looking at the return to your employees and looking at those two numbers in parallel. So the business's ability to pay different notes or different structures will depend on the business, the growth profile, the risk profile, and otherwise. So it's hard to answer that specifically, but I don't know if you want to add anything.
No, I think it comes down to good underwriting. We take very seriously the fact that we're talking about employees' livelihoods, and so the rates we're putting forward to the company are, probably lower from a traditional mezz standpoint. To Zoe's earlier point, the risk profile does demand a higher rate than you're seeing in like a bank loan. But then it's really about the flexibility of the capital. It's, hey, I shouldn't say there's so much LPs around, but we're not going to take a company into receivership. We're going to try and do what we can. And so the fact that we can be flexible, that we're not regulated, that we're not, we don't have amortization, that we don't have prepayment penalty, that we don't have closing costs, all of those things we think, combined with just really conservative underwriting, we think makes for really safe investments. The worst thing that can happen in any of these deals is it gets flipped upside down. That's just a non-starter.
Let's tackle Jason's question, and then we'll do the next cluster. So Jason's question was about exposure at the fund level. Do y'all remember the question? Mm-hmm. Yeah. Do you want to address it?
We don't. I think that'd be awesome. Like, I would love for, A&H 4 to have taken a selling shareholder to come back into the fund, and I think that would be great. On the employee side, I think it's, again, accredited investor rules and SEC regulations that are way above my pay grade, but it's a phenomenal opportunity.
Yeah, I would add to that. In theory, yes, absolutely. That would be amazing to bring the same level of shared ownership that we're seeing in businesses to the fund level. And pragmatically, I think all of us are just focused on getting deals done one by one here to build the space, and hopefully we can build to a future like that.
Leslie?
Thank you. So I love what Phil said about no one understands ESOPs, and so they can't check their boxes, right, to make it work. So in our case, I mean, the businesses that you're trying to support, we have Hispanic craft workers who are our majority owners, but we can't get MWBE treatment because we can't check the box. And so working, if we had that for our customers who are craving that kind of community impact spend, but we can't qualify. So do you have any thoughts on how we can work together to get that recognition for what we're doing to uplift these families?
We think about this all the time. And so to recap for folks, the idea is, yesterday got mentioned the idea of having minority certified companies or a woman certified company. But when you make an employee ownership transaction now, you have this weird thing, like there's this trustee, is that the person, or there's the employees, but they don't really own it, they're beneficiaries of the trust. And it's this very convoluted system. And so what we found is we are very interested in this happening in some broad form, whether it be at NMSDC, whether it be at the federal level. I think the near-term opportunity is at the city and state level, where you can say to a city or say to a state, hey, we're a local business, we have, X number of our employees or X number of our ownership is women or people of color. I think that would be a more beneficial conversation, and then I think that will roll into the idea of a national certification. This is the reason why we're big on this is because there's a lot of minority-owned firms that can't transact for this exact reason. They're like, hey, I need, part of my value proposition is I'm a tier 1 supplier in the auto services. You need that certification, but your employees would qualify. And so again, this is another one where I think the large corporations, the billion dollar round table, that all of that can drive this. I 100% agree. 100% agree.
We have the same issue, and it's something we'd love to work on together with folks.
And I'll say I think there's something particularly exciting about this moment in time where these kinds of questions are now front and center because of the racial equity lens in investing. Other questions or comments from the audience? I saw a bunch of hands earlier. Oh, okay.
Hi, I used to work at the Global Investors for Sustainable Development at the United Nations and the UN Global Compact, and they do a damn good job of branding of both from the institutional investor and the companies from in the case of the UN, the SDG movement, Sustainable Development Goals. Employee ownership is a sustainable development goal here. And I'm just wondering as I watch this, and maybe you guys can talk about branding a bit from both the institutional investor side and from the company side itself, why aren't the big people, like in my situation, I was dealing with Citibank or UBS or PIMCO and things like that, why are they not involved in this movement?
Might have to ask them. Do you all have thoughts about that?
Well, I think it goes back to the earlier questions around, making this more of a movement and more in the top of consciousness of people. And I think it comes down to convenings like this. It comes down to publications. It comes down to success. It comes down to policy. And it comes down to, us reaching out in our networks to engage and bring these people on board.
The only example I know, Joseph Curitan attended this last year from Obron, a cooperative holding company. He is actually working in the health companies, large health companies, and advocating getting them on board to using supply chain that are employee-owned companies. So I think, taking public market companies, they're not going to really shift to employee owner generally, but maybe advocating that their supply chain is employee owned might be one other way to get to memetics and, get the word out. But, I think it's sort of like what Corey Rosen said in the prior panel. It's like, it's frustrating to all of us that there's not more widespread adoption, but maybe it is, to Zoe's point, like we really need to figure out how do we, it's not just convenings and academic publications, like how are we making this, getting this message into everyone's homes?
Great. Yeah, Rupal.
Just a note on that. It seems to me the block there is around the SBA process. So if like a lot of these banks are doing SBA administration loans, and that's where they hit the class of workers and assets that we're talking about, the small and medium businesses. And it's like if the SBA isn't 7A program isn't acknowledging ESOPs, then I think it makes it really hard for the banks to come in. So to me, it's like the policy game is really important in getting these institutions to move. I just wanted to add to that.
Yeah. Well, why don't we bring it back to the Mo? Did I see your hand up? Yeah, great. Let's do. We've got one here, and so Mo first, and then our friend in the back there.
I think that to that end, other than a forum like this kind of panel, I'm curious how much folks like you collaborate on that like bigger messaging, because it's like one thing to have, you know, like any individual, one of you, like make the case for worker ownership, but it's different when all the investment community are banding together and telling that story together about that like really high return rate and like all the successes. I'm curious how much talk there is together within the community to actually like synthesize that for like the wider audience to pitch to these bigger, more anchor institutions.
I think it's an opportunity, but I'm thinking of, Evan, is that you back there from Project Equity? Yeah, maybe you could hand the mic to him, because he's actually driving a PR campaign right now that is going to get the word out to business owners that EO is a great option.
Thank you, Amy. And I didn't walk over here so I was in your sight line, so you would pick me out for that. Yeah, we actually have a few things that we're doing in this regard. With Amy's support, we are presenting the first Employee Ownership Inspiration Award at our upcoming Employee Ownership Equity Summit in May. This is to a business owner that was identified by partners in the field. We took nominations as someone who has had the foresight in terms of implementing employee ownership, not just as their own succession strategy, but really embodied the values that we all hold for employee ownership. And we at Project Equity feel like it's really important to elevate folks like these and these messages so that other business owners can see themselves in the work and understand where they might be like-minded. And we're also doing other storytelling around, you don't have to be mission-driven, like, for instance, our winner this year. You can have other objectives, but employee ownership can still fit for you. So thank you again, Amy, for that support and noting that I was here. I'll also point out that during the Big Ideas segment later today, I'm going to be addressing Corey, Jim, Zoe, Amy, your comments in regard to how it is that we elevate the message, because we really do need to bring forward into consciousness employee ownership, normalize it, bring it into the mainstream. So I'll talk about that later.
Great. And I heard, I want to make sure we sort of pull forward this strand that Mo brought out, which is that there is a specific need for investors to speak with a unified voice to the investment community. And so I've heard that hasn't happened yet. So let's think about what that looks like. And then did I see one more hand here? Yeah.
Yeah, I just want to say we talk a lot about banks, and I think we were talking, Corey mentioned talking about small companies versus large. I'm with JP Morgan. We've got a dedicated team that's been doing this for 17 years, and so there is an understanding on the financing side of it. I think it's depending on the size of the company and where you structure those deals, but there's certainly, it's getting to the right institution that understands how to underwrite these transactions. And Gwyneth on our team over with Global Philanthropy will say, and we're making it part of our whole ecosystem and going down through every level and every size of company and connecting those dots. So 7A, yes, I understand there's efforts underway with the program, and that's going to be helpful at the smaller end of the market. But I think the argument is we're trying to go up market and really drive the larger companies and show that this is a viable structure for any size company.
Great. Okay, parting shots, last words. Anything you didn't get to say that you'd like to leave the audience with? Have a great lunch.
Yeah, we covered it.